Hey YouTube, welcome back to Ostrich Investing. So I'm just minding my own business last night, procrastinating on my next video as per usual. And next video was going to be on RioCan. And then I see that they've cut their distribution by 33%. So I had to decide I'm either going to finish this video or going to have to move on to the next one. So anyway, I jumped in last night and finished up my video on RioCan. And that's what we're going to talk about today. So RioCan's focused on retail real estate. It's one of Canada's largest and longest standing REITs. I didn't actually fact check the largest, so feel free to come at me on that one, but it's definitely one of the longest standing REITs. They cut their distribution on December 3rd, which was yesterday. And with the context of a new CEO, Jonathan Gitlin, I hope I'm pronouncing that right, set to take over the reins from Ed Sunshine in April 2021. So highlights of the company. So despite the retail and COVID headwinds, historically the REITs generated pretty stable cash flow from its properties, and they're anchored by major tenants like Loblaws and Canadian Tire. Company does have upside from potential for redevelopment of certain of its properties, which we'll talk about later. The distribution yield after the cut, so as of this morning, is 5.5% to investors, so not as attractive as it was 2 days ago, but there it is. And leverage is reasonable, 44% debt to assets, and there's some reasonable liquidity and unencumbered assets that they have we'll talk about later. So this video is going to explore if shares of RioCan are attractive at current levels. Disclosure, I looked at this one, especially in March and through COVID and some of the other Canadian real estate names, but I do not own RioCan. So here we go. Let's start out on the business. Where to start here? Let's start with the map on the top right. You can see, and they make a point of letting you know that their portfolio is 90% in basically 6 of the major cities in Canada, with 50% plus in Toronto. 90% of the portfolio is retail real estate. So obviously right now that's one of the worst places to be in real estate. But they talk about increasingly a mixed use portfolio. Some of their redevelopment, in fact, most of their redevelopment has a residential and some office component. So they are moving to diversify away from basically a retail pure play. What else do we want to say here? Yeah, you can see in the retail split, mixed use urban is growing. I believe it's an area that the management's focusing on, but historically it's grocery anchored centers and open air centers that account for the majority of their properties, and net leasable area, call it 76% from those types of properties. Okay, unit price. It has been a drop off, as you would expect. So RioCan's traded, up to close to $30 over the last 5 years, down to a low of, I think it went just below 14 in March. And importantly, I think the unit price dropped from $27.50 pre-COVID or pre their Q4 February earnings to $14 this year. So the unit price has been cut in half. It's recently started to recover. And then this chart was pulled after close yesterday. And so the unit price at yesterday's close was $18.03. They announced the distribution cut, after the close. And you can see this morning that the unit price dropped 3.5% to $17.40. So this chart is 1 day outdated. And I guess what that tells you is the distribution cut was largely priced in to the stock. Selected annual information. So the last few years, some key financials for RioCan. And what we're going to see here is that despite some of the headwinds in the retail sector over the last few years, RioCan results had been relatively stable pre-COVID. So you can see here revenue at the top going from 1.15 to 1.3. There is some of that redevelopment revenue in there that's driving most of the increase in revenue, but either way, revenue is stable to slightly growing. Funds from operations, FFO, stable, slightly down, 584, 580, 575, 576, but stable. Same property net operating income growth in the 6 major markets, over 2% each year. So again, despite some of the retail headwinds pre-COVID, the results had been relatively stable. Okay, 2020 has been much more challenging. Dr. Evil coming in to appreciate the insight that I'm bringing to all the viewers out there. It's been a tough year, and you can see FFO has dropped significantly from 430 to 383, and this is for the 9 months ended September 30th. And you can see here the same property NOI that we saw positive 2% for the last 3 years has dropped off meaningfully. And I think we got one more here. And you can see what it did to the payout ratio. Now, this payout ratio on available funds is over the last 12 months. But if you looked at it from a 9 months year to date annualized perspective, it was over 100%. I believe it's about 103, 104%. So their payout ratio was exceeding 100% year to date. So we'll talk about the CEOs. We'll talk about the one who's on the way out and the one who's on the way in and the distribution cut. And I thought I was going to have a really cool slide here for you. I had Ed Sunshine. I was hoping to record audio from his comments on the Q2 conference call, as well as Jonathan Gitlin for his comments on BNN the day he was appointed CEO. Very contrasting views on the safety of the distribution, and I think as an investor that was probably your tell. But I'm such a poor YouTuber that I couldn't figure out how to record an audio snip and include it here in the presentation. So you'll just have to take my word for it. If you are interested, I'd highly recommend going and checking them out. So July 29th, the Q2 earnings call, Ed Sunshine in his closing prepared remarks on the distribution safety talked about distribution being their promise to investors. There's a lot more to it. It's about a minute where he goes on and doesn't 100% assure the dividend, but speaks as though the dividend is safe. October 21st, we had the changing of the guard, where in April 2021, Jonathan Gitlin's going to take over. And of course, the same day, BNN had him on for an interview. And if you listen to his piece when he was asked about the safety of the distribution, it's a very different answer. He commented about the fact that it's an uncertain environment. It's ultimately at the board's discretion. It's one way that they might be able to raise capital. So if you were just to compare and contrast those two interviews, you probably would have known what was coming. And then here we are, December 3rd, RioCan announced the distribution cut. And judging by the market's reaction today, with the unit price down only 3.5%, you could tell that the market expected this or thought that it was coming. Okay, before we get into a couple other business trends to talk about, I just wanted to spend maybe a minute on the CEO ownership, because when I was reviewing RioCan back in March, it's one of the things that stood out to me. So Ed Sunshine is a sort of powerhouse in Canadian real estate. It's been around for 20 plus years, founded RioCan back in the 90s, and has essentially been at the helm for over 2 decades. And I was just shocked that he only owns 500,000 units of the trust. So if there's 300 million units outstanding, he's like less than 0.5% ownership. And it just shocked me. It kind of rubbed me the wrong way, actually. And obviously, to each their own. He doesn't owe it to anyone to own shares. But to me, as an investor, with someone like this who's founded the company and been around and been the CEO for so many years, you can see his compensation on the right here, sort of clearing 6 million plus a year, to only have 500 units worth about $9 million. It just seemed very odd to me. So anyway, just something to point out to you. tenant profile. So let's talk about how RioCan generates rent. At the beginning of COVID, I mean, there were retailers that just simply were refusing to pay rent. Now that's largely gone away. 94% of their tenants are currently paying, or 94% of rent is being received. I should say it that way. Um, but to me, you got to dig a little bit deeper. Obviously, that would be the near-term potential liquidity crunch if RioCan wasn't receiving any rent and still needed to meet its debt obligations. So we can move past that now for the time being. They're receiving 94% of their rent. But I think the bigger story is that several tenants are suffering and may not survive. And I think that gives a risk of lower occupancy, which is currently at 96%. Lease expiries, which we'll talk about in a second, and rental rates, what happens to rental rates. So if you look at the chart here that has all the logos on it that they put up in their 2019 annual report, this is meant to be a very positive chart with all these strong logos. But if you just dig a little bit deeper, and granted there's a lot of strong logos on the chart, and they're of course not including all of their tenants here, but you can quickly see that not all of these companies are doing well. The Indigo is struggling. Cineplex, Landmark Theaters, struggling extremely. Cineplex has a ton of debt. I mean, you could question their viability. Reitmans filed for bankruptcy. Bed Bath and Beyond had been struggling. Hudson's Bay struggling. So you can go through the list, and even though these are the logos that they've picked to sort of show you how strong and resilient their portfolio is, there's a bunch in there that aren't doing that well. So I think just important to note. Here you can see their top 10 tenants get you to 28%. So while they've got lots of strong tenants, they're extremely diversified, which is both a strength and a risk that we'll talk about later in my mind. And I think lastly here, we'll talk about their lease expiries. So you can see over the next, in 2021 to 3, there's over 10% of their portfolio square footage that comes up for lease renewal. And you can see the average net rent per square foot. And I think it's a question that you want to ask yourself as an investor is, number one, are there going to be increased vacancies as these leases roll over? If so, if not, are the in-place rents going to be able to be maintained, or are they going to take a little bit of a hit? Will RioCan need to make some concessions to keep certain tenants in place? It's a question. Redevelopment, I think a big part of the story, and if you go back, I'm probably going to get this wrong, maybe it was 2 years ago or a year and a half ago when RioCan first came out with their redevelopment plan, they talked about, how much value this could bring unit holders. And I think, if you're a bull for RioCan, this is a key part of the story that you're probably buying into. So we'll talk about a few things here. First is they've got what they say 42 million square feet of pipeline for redevelopment. 14.3 million of that has zoning already approved. And that's an important piece. So those technically, when they get the funding and they think that the demand is there, they could move forward with those projects. 73% of their redevelopment activities are located in the GTA or Toronto. So if you're a believer that Toronto real estate market, particularly on the residential side, will continue to be stronger, residential office, then there could be a lot of value that RioCan could surface here. A little bit about the math. If you really want to look into this, you've got to do some math, and you think it's one thing for them to redevelop their properties, but that takes money, and how much money they put in versus what it's worth at the end of the day. You need to sort of run the math on that. And they have this is what they have in their investor presentation, obviously very high level. They talk about, the build cost and the cost of them building these properties, sort of a development yield of 5.5%. But once they're built, you think about a rental building in Toronto for residential, that cap rate might be 3.5%. And so if they go in at a 5.5% kind of go in development yield, and they can sell it or monetize it at 3.5%, then they've created value, and that's what they're telling you here. But of course, you'd really have to dive into that side of the story and get comfortable with how much value you think they can create. And there's a few examples of projects that they have in Toronto. Last point here is that as of last year, they are starting to generate some income. So we talked about at the beginning, 200 million of their revenue in 2019 was residential inventory sales. So imagine residential condos. And then here you can see the cost of that inventory. So 209 million of residential inventory sales, 173 million of cost that relates to selling that inventory. So, adding an extra, call it, where's my math here, 35 million in profit each year. So it's not nothing. Balance sheet, just spend 20 seconds on this. I don't see any major issues here. One of the things that I like, I think their debt levels are reasonable at 44%. What I really like is this $8.7 billion of unencumbered assets. And you can question whether those assets are still worth 8.7 billion today. But I think the point is they've got a significant number of properties that have no debt on them, which is going to afford them a lot of flexibility if they ever needed to. But all of the metrics here don't look crazy. And so I'm not overly concerned on the leverage, obviously, unless the business continues to deteriorate significantly. Okay, last one before we talk about the key risks, key strengths and drivers, and the bull basin bear scenario. I want to talk about comparables, or comparable in this case, because I was trying to get this video done last night, as well as I think SmartCentres REIT is the best comparable to look at. They have some similarities, so we'll walk through it here. So RioCan, from a size perspective, market cap of 6 billion, EV of 12 billion. SmartCentres slightly smaller, EV of 9 billion. Just note, I didn't check these numbers, so I just relied on third-party sources here. Business and structure. So both of them are majority retail. Both of them have significant Ontario presence, 65% in RioCan, 63% for SmartCentres. But diversification is interesting. SmartCentres has 25% of their revenue coming from Walmart, whereas RioCan, their top tenant's Canadian Tire at 5%. So interesting here. SmartCentres very well known for sort of having many properties with Walmart as their anchor tenant. So Walmart being 25% of revenue here. And then on the structure, RioCan has a relatively simple REIT structure, internal management, but there's limited management ownership, as we saw with Ed Sunshine. Over on the SmartCentres side, structure is more complex. Related party transactions with Mitch Goldar through Penguin, but he does own 20% of the units. So there's much more to peel back there. And frankly, I haven't done the work, but it's more of a complex structure for a unit holder. Redevelopment potential. This is not scientific. This is just based on my reading and my sense. I think RioCan has medium potential. They've got 206 properties, 36,000 square feet, sorry. The total acres are not disclosed. And when I was reading a little bit on SmartCentres, what I found was interesting is they talk about this a lot. I think their redevelopment potential is high. And I'm judging that purely on the number of slides that they show their properties in their investor presentation. So if you have a minute, take a look and you can see just how many properties they have. And they talk about the number of acres in their properties. So they've got 166 properties, 34,000 square feet. So about the same number of square feet in terms of leasable space, but they have 3,500 acres, and they make a point of letting you know that 2,775 of those acres are unbuilt. So when you see the pictures of their properties, picture those big strip malls, often next to transit, next to highways that are big areas, huge parking lots. And while RioCan has some of these properties, to be sure, it feels like, I haven't done all the calculations, that SmartCentres is in a better position here and just owns more land underneath. Again, I wish that RioCan disclosed the acres, because I'd love to have that stat for you here. Dividend and payout ratio, 5.3%, I guess 5.5% this morning after the unit price fell by 3%. Post-cut payout ratio on AFFO is 70%. I think, most management and boards, if they do need to cut the distribution, want to make sure that's the one cut. So obviously they've given themselves some room here, and I think unless the retail environment in Canada just continues to really deteriorate more meaningfully than they're expecting, I wouldn't expect another distribution cut in the near term. SmartCentres hasn't cut the distribution yet, 7.6% yield and a 90% payout on AFFO. So I guess just to note, RioCan pre the cut was probably about 105% payout ratio. SmartCentres is still managing at about a 90% payout ratio. Leverage, very similar, also have significant unencumbered assets at both. Valuation, very similar. And after this morning, it might be bang on after the unit price dropped, although I think SmartCentres dropped a little bit in sympathy as well. 11 times FFO for an estimate of 2020. So very similar businesses. Obviously, the market views them very similarly as well from a valuation perspective. I think you get a more simple structure at RioCan, but maybe not quite as much redevelopment potential. Whereas at SmartCentres, you probably get a higher amount of redevelopment potential, more land underneath, but more complex structure. So there you go. Here we are, key considerations for the stock. Strengths for RioCan. Quickly here, I agree, an attractive portfolio concentrated in Canada's 6 major markets, as they talked about when we did the overview of the business. Balance sheet flexibility, I think, is a strength here. They've got $8 billion plus in unencumbered properties, which can be helpful either to put some debt on financing or to sell. They've got significant redevelopment plans, right, which takes capital. So I think the fact that they have the flexibility in their balance sheet is a good thing. And a diversified tenant base. As you can tell, they've got an extremely diversified tenant base. Canadian Tire, their top tenant, is 5% of revenue. So revenue is spread across many tenants. Risks, retail headwinds, not much insight there, but we know it's been a challenging environment. Diversified tenant base, I actually also put as a risk here. I think, unlike SmartCentres, which has a 25% Walmart anchor that you could probably hang your hat on, RioCan has a lot of tenants that might be weaker that are 1%, maybe 2%, 3% of revenue. And when you add all those up, 1% of revenue, RioCan's revenue is $1 billion. So that's 10 million. And that's basically, if that rent falls away and can't be replaced, that's 10 million coming right out of your FFO. Impairment of retail real estate value. I think this is a key risk for investors is, there aren't many people lining up to buy retail properties right now. And on the next slide in our bull and bear case scenarios, we'll talk about how they're valuing the properties on the balance sheet right now. And can the market support the redevelopment? One thing I find interesting is it seems like every REIT is running the same playbook. RioCan, SmartCentres, Brookfield, everyone's doing it. They want to redevelop all of their properties, but at a certain point, is there going to be too much supply? Is there going to be demand for all of these projects? And that remains to be seen. It's just a question. Key drivers for the unit. Valuation cap rates for retail real estate. I think it's going to be a huge driver, obviously. Post-COVID occupancy, can they keep it in the 90% plus range as we emerge from COVID? Be interesting to see. Leasing renewal rate growth or decline, and densification execution / upside. So can they execute on the densification? And if they execute, can they generate incremental value for unit holders? And you can see one of their projects in Toronto, The Well, currently under construction. So here we go. Last slide, illustrative scenarios for the stock. I've done some math here, but it is for illustrative purposes only. Lots of assumptions, but I wanted to show you just how much certain changes in assumptions can drive pretty large increases or decreases in the NAV for the unit. So in the bull case, let's assume COVID vaccine comes, we return to normal, rental rates hold, occupancy stabilizes. We're kind of back to normal. Still some retail headwinds, but we're sort of back to normal. And here we're assuming that there's no impairment of retail properties. So the cap rate that RioCan's using to value their portfolio as at the end of Q3, the weighted average cap rate is 5.45%. So we're assuming that that stays consistent. We're also going to assume that their redevelopment plans drives an incremental $5 per unit in value. Again, I haven't done a ton of math here. I've just kind of eyeballed it to be honest with you, but just saying you think you can get an extra $5 in value from the redevelopment activities. That gets you an implied unit price of $25 per unit, and that's 40% plus upside on the stock. So if you can see here, here's my net asset value per unit sensitivity analysis based on occupancy, which is currently at 96%, and weighted average cap rate, which again, they're currently at 5.45%. So this is close to where they are currently. The bear case, rental rates hold, so that average of sort of $20 per square foot, but occupancy declines from 96 to 85%. And there is impairment of retail properties. Again, who's out there buying them, and if there was a market to sell them, what's the cap rate? And so we've had a meaningful widening of the cap rate here to 7%. Redevelopment still drives $2 per unit in value. I think, even in the bear case, looks like they do have some projects that are, even if you just counted the ones that are going now, I think it's fair to assume without a collapse in residential real estate in Canada, there is some value to be had there. But really, and the whole point, this is very illustrative. The whole point is to show that a few tweaks, and especially the cap rate, if the cap rate widens and occupancy comes in, your implied unit price, like here we get to $10.44, add $2 for redevelopment value, you're a little over $12. So it can significantly change, the implied value at RioCan. So that would be a 33% downside versus RioCan's close yesterday. Last point I'm going to make on this one, that is all based on their net operating income of $692 million in 2019. So this is giving them the benefit of sort of pre-COVID NOI. So this could flex down even further, particularly if you were going to be more bearish on rental rates. Conclusion: there's a lot of math on the last slide. So RioCan cut their distribution, and the unit price fell 3.5% the morning after. I didn't appreciate it because I had to hurry up and finish this video. But the point is, the market basically had priced it in. Headwinds in commercial real estate didn't just begin with COVID. They'd been here for a few years. COVID just exacerbated the issue. Just Google a list of retail bankruptcy filings in 2020 and you'll see a pretty long list of names. We know RioCan has a diversified tenant base, but expect increased vacancies in the coming years. Some questions I was thinking about, could you, when you do get vacancies, can you repurpose the space? What about pricing on renewals with existing tenants? Who's got the power in those negotiations? Large tenants and anchors like grocery stores aren't really going to want to move, but who has the leverage? Cineplex, another example, call it about 4% of their revenue. That's $40 million. Cineplex is not in great shape right now. If they were to go away, that's a meaningful hit to the company's net operating income and profitability. So for me, too much uncertainty, not enough upside for me to be interested. But I think if I were to kind of just flip the lens a little bit, I could be underestimating the redevelopment potential. And that could be, maybe that's what I'm missing here. Smart centers looked more interesting to me on the surface, but I would have to do more research. Yeah, but it looked a little bit more interesting to me just as I was checking it out as a comparable. Let me know your thoughts. Will there be permanent impairment in the value of Canadian retail real estate? Do you like RioCan here? Is the new distribution safe? Let me know your thoughts. Thanks for watching. We will be back at some point with more videos, but until then, happy investing and don't bury your head in the sand.